Chapter 13 is the third of the three chapters, talking about different ways you can invest. Chapter 11 was on the bonds. Chapter 12 is on stocks, and Chapter 13 is about mutual funds, which, in my opinion, is probably the way to go for almost all investors, will be to invest in mutual funds. Mutual fund is an investment vehicle. It's put together by companies, and what they allow individuals to do is pool their money together. So you and hundreds and thousands of other people, and then this investment company makes investments on your behalf. They buy stocks, bonds, gold, a whole variety of financial securities. What they're actually buying depends upon the mutual fund you buy. Right? Some mutual funds will buy just technology stocks. Some mutual funds will buy only foreign stocks. Some companies will have mutual funds that only buy Japanese stocks. You can use all sorts of different funds. There's actually more mutual funds available than there are actual stocks to buy. So the mutual funds are just a huge number of them. And then the thing about a mutual fund, which many people find attractive, myself included, is that the mutual fund is making the buy and sell decisions, whether the stock should be purchased or sold. It's being made by a professional fund manager rather than an individual. And I don't spend my entire life studying financial markets. I have a job and a family, etc. I devote most of my time to other things. It's great to have someone else focusing on how to invest the money. By delegating this authority to buy and sell to someone else, they receive compensation. So the disadvantage of a mutual fund is that they are basically charging you fees to do these investment decisions for you. In the most cases, and especially with properly and carefully purchased mutual funds, the advantage of mutual funds way outweigh any negatives involving cost. One thing that I will stress as much as anything about buying mutual funds is you have to be really sensitive. Focus on cost when you purchase a mutual fund. Mutual funds that have high cost are bad deals. You want to focus on low cost mutual funds. What are the two main reasons why people purchase mutual funds? One is professional management, right? So you have people whose full-time job, entire organizations, are to manage the money. One thing you need to ask, and it's certainly a problem, is who is the fund manager, right? If you're not going to choose an index fund, which is what I probably would recommend to almost everyone, we'll talk about what they are in just a few minutes. If you're going to buy an actively traded mutual fund, you're basically buying some reliability of the manager, the person who's doing the buying and selling of the stocks. So that's something you need to investigate. And you're also going to want to ask, how has that fund performed under that manager, right? A mutual fund will turn over managers fairly quickly. It's one of the challenges of buying mutual funds that are not index funds, because you might like, John Doe, the manager of, Rutgers Investment Company's stock mutual fund, but that person may only be managing that fund for 3 years. Which is about the typical amount of time a fund manager manages a fund. And then your money's with the fund with someone that you may not like, and therefore you might want to switch funds. And all this buying and selling of funds turns out to be kind of expensive. It'd be way better off if you were buying a fund that you could just buy and hold. The other huge advantage of why people buy mutual funds is mutual funds allow you to diversify. So if you bought, let's say, an S&P 500 index fund, you'd be buying by one fund, you'd actually really be buying shares in 500 companies. And that gives you diversification that is really difficult for an individual just purchasing stocks to achieve. You have to have a huge amount of money to diversify in the same way with your own stock purchases than you would if you just bought a single mutual fund. If you buy the total stock market index fund, an index fund that has shares in every stock, you're actually buying shares effectively in 6,000 companies with buying one mutual fund. That's super attractive because diversification done right reduces risk. Now, you can see in my last bullet point there, I wrote risk reduction or not, because depending upon the mutual fund you purchase, depending upon what they're doing, it easily can be the case that you're buying a mutual fund specifically because you like the fact that that manager is specifically pursuing a specific, very risky stock strategy. Risky doesn't necessarily mean bad. We have to recognize that it may be taking on huge leveraged bets or heavy investments in a certain sector. So, for instance, if in 2007 you had invested in a mutual fund that was heavily invested in financial markets, you would have taken an absolute bloodbath because that was kind of it turns out to be a high risk, very sector specific mutual fund. So, in general, when you buy mutual funds, the fact that a lot of mutual funds hold hundreds or even thousands of companies, that's risk reducing. However, certain mutual funds, among the 9,000 mutual funds that are out there, there are a lot of them that are actually enhance your risk, that is increase your risk, and you're doing so because you think there's going to be return to that risk. There are three main types of mutual funds. Closed-end funds, where a closed-end mutual fund is they've only issued a certain number of shares. Okay, so this again may be a mutual fund where a manager is managing stocks, and they've only issued, let's say, 100,000 shares. Also, only 100,000 of these little rights to own that mutual fund are out there. And so, in that particular case, when you're buying and selling the mutual fund that's closed in, the price of that does not have to reflect actually the underlying price of the various stocks and assets that's being purchased. There may be exuberance that this guy's on a hot streak and the price gets bid up far higher than the actual price of the funds he's really buying. And if things are going poorly, the price can fall below. Almost everyone buys one of the other two types. Close-end in mutual funds are kind of losing momentum. People don't buy them nearly as much as they used to. There's far fewer of them. Most people buy either what's called an open-ended mutual fund or an exchange-traded fund. An open-ended mutual fund is you're buying a fund, so that means a collection of stocks or equities, sometimes bonds, and then the price of the mutual fund is set at the end of every day. Okay, so the market closes, and so by 5 or 6 o'clock, the price of the actual assets that company owns are computed, and then the price is updated. So for an open-ended mutual fund, the price is updated once a day. Okay, and so if at 6 o'clock the price is $60 for all the assets in it, when you buy or sell until the next update, you're buying and selling at that price, okay? And then the next day, it'll be updated and maybe it'll go up to $60.03, okay? So open-ended funds, the price of the fund completely reflects the net asset value of the actual stocks or equities or bonds that the fund owns. Such funds can either be actively or passively managed. We're going to discuss that in a second. Exchange-traded funds are like open-ended funds, basically, except the difference is that they're priced like a stock. That is, all day long, their prices are changing. So it's a mutual fund. So the true value of what you're purchasing is based on the shares of what's owned, but it allows people to trade during the day. So again, when you buy a standard open-ended mutual fund, you're buying and selling during the day. But in truth, the transaction only occurs at the end of the business day. So you can go on and buy and sell mutual fund shares, open-ended mutual fund shares at, say, 2 o'clock in the afternoon. But the transaction will not occur until the price is determined at the end of the day. An exchange-traded fund, there's a price that is constantly being updated. It's going to be a very, very close resemblance. It'll be very much like what people think the manager is holding in that exchange-traded fund. But there can be price deviations between an exchange-traded fund and the actual assets in it. I've mentioned this term net asset value. A net asset value is kind of the price of a mutual fund. And so what it is the value of everything the fund has purchased, so the fund's portfolio, minus any liabilities the fund has. So sometimes funds actually take on debt as they get started in particular, or they may have other expenses that they've incurred. So basically you can think of it as the value of the portfolio divided by the number of outstanding shares. Okay, and then that reflects the price of the mutual fund. And that's computed, like I said, once a day at the close of the business day. So probably as much as any factor when you buy a mutual fund, you have to pay attention to cost. There is a variety of costs associated with a mutual fund. Specifically, one big cost is you can buy a load mutual fund or a no-load mutual fund. Load is the term paid to commission, when you pay a commission. So there can be mutual funds that charge you somewhere between 3%, 5%, 8% to actually purchase the shares. Okay, so let's say that you have a mutual fund that has a 5% load. When you give them $100 to buy a share, $5 of your $100 will, sorry about that, $5 of your mutual fund go to commission, and only $95 actually go to buying shares. No-load mutual funds have no commission paid. Loaded mutual funds were clearly the dominant form in the market. They were basically the only type of mutual fund you could buy up until about the mid-1970s. And up until about the mid-1990s, they were still the predominant form. Things have really changed, and now there's just a huge number of no-load mutual funds out there. And most people now are purchasing no-load mutual funds. I actually feel fairly strong. There's almost no sense at all to anyone ever purchasing a loaded mutual fund, since there are so many no-load funds out there. There's also back-end load. So I discussed basically a front-end load, which is a commission that you pay when you buy. Some mutual funds have what are called redemption fees or back-end loads. And so the day you want to sell your mutual fund, you may have to pay 2% of whatever the value is back to the company. So if you can imagine, you might pay a 5% front-end load and a 2% back-end load. That's a really heavy cost to owning that particular fund. In most cases, although not all, the back-end loads decrease over time. So it might be a 2% load for the first year you own shares, and then it goes down to 1% for the next 2 years you buy the mutual fund. And if you own the shares for, let's say, 4 or 5 years or longer, there's no redemption fee. Redemption fees in some ways are trying to discourage you from selling the mutual fund. And as I have them in this last red bullet point here, in all honesty, it's really hard to imagine why people would buy a loaded fund, either a front-end or a back-end load, because there are so many no-load mutual funds available. Whether you buy a no-load or a loaded mutual fund, there's also expense fees associated with the fund. Okay, so the operational expenses of owning a mutual fund, the company will tell you at the beginning of each year what percent of the money it's going to charge you to manage your money. This can vary. It can be as high as 2%, but in most cases now, mutual fund expenses are less than 1%, and there are many mutual funds that are less than 0.25%. I want to emphasize that expense fees were kind of a hidden secret for many, many years, where most investors ignored them. And now I think it's a growing recognition of how important low expenses are. So in addition to buying no-load funds, you really want to focus on low expense funds. So, everything else being equal, you can buy an S&P 500 mutual fund. So a mutual fund that's buying the S&P 500, very attractive investment option for many, many people. And you can pay 0.04%, or you could pay 1.5%. And so why you'd pay all that extra fees for someone to do exactly the same thing that someone will charge you literally 0.04%, it just doesn't make sense. I think most people, and you might be listening to this lecture thinking that why 1% is not that big a deal. In fact, it really is. So, for instance, an S&P 500 mutual fund you might expect could generate something around, let's just say, 8.25% return. Okay, that would be a typical long-run return to the S&P 500. And suppose you're going to invest for 30 years. So a woman named Karen, let's suppose she puts in $10,000. So she's saving for her retirement. She puts $10,000 each year in her 401k, and that's invested in an S&P 500 index fund. She, however, chooses a relatively high-cost company, and she pays 1.25% expense ratio. So her net return is only going to be 7%. It's actually the S&P 500 return minus the expenses the company charges her. Jill is exactly the same. Jill saves $10,000 a year for 30 years. She chooses a low-cost company, so she's only paying 0.25%. Okay, so her net return is 8%. Karen, you can go to the end of Chapter 1. You can look this up, either the spreadsheet I gave you or look in the tables at the end of Chapter 1. Karen, saving $10,000 a year for 30 years with a net return of 7%, will have $944,000. Okay, and Jill will have $1.1 million. It's over or just under $200,000 difference. So you can imagine they're saving for retirement. It might be the case, for instance, that Jill has the equivalent of 2 more years of salary. Suppose both of them make about $100,000 a year. $188,000 is like Jill has 2 extra years of salary in her retirement account than Karen does, and it's all because of the 1% expense ratio. Expense ratios are one of the most important things. You go for no-load mutual funds and then really low expense ratio mutual funds to the extent that you can. Now, there are in addition to load and no-load, there are 2 categories you can classify mutual funds into: managed funds and index funds. Index funds are a relatively recent phenomenon. They're only got started in 1975 and really didn't take off until about 1990. So they're only a little over 20 years old. Managed funds have been around for, not quite 100 years. In a managed fund, the fund manager is making decisions whether to buy or sell certain securities, stocks, bonds. Okay, in an index fund, the person managing the fund, in fact, does not have to do very much. You simply buy and sell the securities that are in a specific index. So if you're the S&P 500, you never think about buying a company that's not in the S&P 500. You, in fact, buy try to replicate the S&P 500 index. So there's 500 companies, and you buy the shares in your fund exactly in the same proportion that they're in the S&P 500 index. It's actually relatively easy to do an index fund. So the cost, which we just finished talking about, almost always for an index fund are considerably less than a managed fund. And there are literally dozens and dozens and dozens of different types of index funds. Probably the largest, most popular one is a variety of companies offering S&P 500 index fund. Those are basically U.S. large cap companies. But there's also small cap mutual funds, small cap value. There's European index funds, Japanese index funds, emerging markets. So basically, when you think about buying a series of mutual funds, you might think about the types of where would you like to own stock. I'd like to own some stock in Europe. I'd like to own some stock in emerging markets. And I'd like some small companies and some large companies. And you could just buy an index fund for each of those things you want. Okay, and then that's what you own rather than having a manager buy and sell stock for you. Now, it's really hard to know what mutual funds to buy, or at least for many people it is. There are literally like 9,000 mutual funds out there, 10,000 mutual funds. Okay, how would you know out of 10,000 mutual funds which ones to buy? Well, there's a growing academic literature, a lot of empirical results, almost overwhelming, that it's very, very difficult for a manager to beat an index fund. And for a long time, this puzzled people in the market. So if you're going to look at anything more than 1 year, if you get to 3 years, it's very rare for a mutual fund that's being actively managed to beat an index fund that's comparable. So that is, if you have an active manager who's got a mutual fund that's buying value stocks, if you just bought a value index, you would beat it. So for instance, here I have some data at the bottom. This is recent data. If you look across different types of indices, actively managed companies in any 1 year period, somewhere between 30 and 60% of the actively managed mutual funds beat their index. But if you go to a 3-year period, it falls to somewhere between 10 and 20%. So no more than 10% of mutual funds in any 3-year period, maybe up to 20%. That's actually getting a pretty high number, will beat an index. And if you go to a longer period, like 10 years, it falls to definitely less than 10% of the active companies. Now, if you go to a long period, like 25 years, it gets down to be like 1 or 2%. So basically, when you look at the results, managed funds really have a hard time beating index funds. And one of the main reasons is that managed funds have higher expenses. So me as an investor, while a managed fund possibly will slightly eke out, get a slightly higher return than an index fund, the expenses that the manager charges me more than eats up the amount that person can beat the index fund. Okay, so the most academics now recommend that you buy index fund. Index funds only account for between 15 and 20% of all the money in the market, though. Most of the money is in actively managed funds. Let me say that even if you believe the idea that you want to buy an index fund, there's literally hundreds and hundreds of index funds out there. So let me recommend this link right here, which there's a series of what are called lazy portfolios. These are pre-built on the internet. These are people's recommendation, really knowledgeable people giving recommendations for really low-cost index funds. And so one of the most popular of these is a 3-fund portfolio. So they said all you need to do is to buy 3 mutual funds. And the evidence is overwhelming that if you buy those 3 funds, you'll get better returns and better diversification than most professional portfolios that you'd actually pay money to have them construct for you. And it's one of these odd things that there's a huge marketing machine in Wall Street to tell you need managers to manage your money. In fact, if you just follow simple rules of these no load, low cost index funds, you can actually do better than private managers. It's something that most people have a hard time believing, but the evidence is in the data. When you buy a mutual fund, a little bit like stocks, there's three ways you earn money. One is you get income dividends, and that is the mutual fund owns stocks. Those stocks pay dividends, and the mutual fund then gets those dividends, and you can choose to either have those dividends sent back to you or reinvested so you accrue more and more shares of the mutual fund. You can get capital gains distribution. So that is the mutual fund company, if it's actively managed, it will buy and sell stocks and sometimes make money. And in that money that it's making, it can distribute the earnings on that if you'd like to you, or you can have it reinvested. And there's capital gains and losses, and that is the securities that you own in the mutual fund can earn, the price can go up and you'll earn money over time. So that's my very brief discussion of this chapter on mutual funds. The important takeaways is they provide huge amounts of diversification. They're a really sensible way to buy a large variety of stocks. You should focus on no-load funds. You should focus on low-expense funds. And in almost all cases, people would benefit from buying index funds. And if you need suggestions on what index funds to buy, you want to Google lazy portfolios, and you'll come up with a variety of all of them very good suggestions, some of them ranging from just 2 funds, some to 3 funds, some to 7 funds. And choose any of them, and they're all going to be better than what most private managers would give you. Good luck.